Hello and welcome to the latest Wealth of Advice market update on the 10th of May 2023. So we start off with some market news. Stocks and shares have remained buoyant over the last few months. However, when I say buoyant, they are up and down quite a bit with a lot of volatility that's going on in the world. The banking issue that caused problems February into March, which we were assured was only limited to a couple of banks, reared its head again a few weeks ago when First National Bank in the US went under again. As a result of it going under, a bigger bank came and gobbled it up, and all depositors over there were safe and secure. To reassure people in the UK, because I have had one or two clients ask about this, the UK banking rules are as strong as ever. We tightened them up after the 2008-2009 financial crash. The problem in America was that in 2018, the then President Trump decided to roll back some of those rules for American banks, and it made a lot of banks a little bit more insecure because of how much money that they hold on deposit and such like. So we definitely believe that that banking issue in America is limited to that particular area, but it did cause a lot of volatility in the markets when obviously they heard news that banks were getting into trouble. If you would look at the individual share prices of some of the big technology companies, your Apple, Amazon, Facebook, Google's, for example, since the turn of the year, they've done very well. Share prices have done really good since the turn of the year for those big, huge companies. Their earnings are coming through and the earnings are looking good. There's no signs of a large slowdown. People are obviously still buying Apple products, using Amazon for all sorts of goods and such like. Facebook, it's believed, has turned a corner whereby it's getting more revenue coming in from different sources, and it's kind of overcome some of the problems which saw its share price go down 60% in 2022. Same applies to Google. There was worries over Google's future income streams, but it shows that they're doing okay. And as they continue to focus on driving efficiencies, which basically means they laid a lot of people off in 2022, they're now starting to see more profit come through as a result of these job cuts. Overall, corporate profit margins are slowly shrinking. That's because of inflation. Cost pressures are going up, so that does have a squeeze on margins. You see this in every inflationary time. Again, we have to look across to what the Federal Reserve Bank's going to do, what the Bank of England does in respect of interest rates and how much of effect that's having on inflation. And hopefully we start to see those inflation numbers fall soon. Talking about interest rates, you will have noticed maybe in the news last week that the US Central Bank raised interest rates by another 0.25%. That's the 10th rise on US interest rates in the last 14 months. So that means US rates are now 5.25%. I'm recording this on Wednesday afternoon. The Bank of England are due to have their regular meeting tomorrow on the Thursday. It's expected that we're going to raise interest rates by another 0.25% as well. In both the UK and in the US, there's market hope that this might be the end of interest rate rises, because obviously they don't just move rates kind of from 0 to 5% overnight. That would really shock the market, so they gradually increase them by 0.25% or 0.5% each time. And it's hoping that we're now getting to the point where rates may have reached the peak. The US Federal Reserve Chairman Jerome Powell still thinks it may take time for inflation to come down to the levels they want it to. So they don't think they're going to cut rates in the short term. However, if you were to look on Bloomberg, for instance, and look at long-term interest rates, markets are pricing in that rates may come down at the end of this year. Certainly not, if certainly it's not at the end of this year, maybe into next year. The other problem that you've got all over the world is, although inflation is high, consumer demand is still there. So when you do talk to a lot of people in this country who might moan about the cost of food, etc., they're still going out and buying it. I think what you're starting to see now is some of the bigger ticket items people are holding back from. I was talking to a hotel owner yesterday in a client meeting who's telling me that the bookings for May, June and July this year appear to be down because people are probably not going to have a holiday this year with the cost of everything else so much, maybe saving up to go away next year, for example. And as you see across the UK, there's lots of strikes going on where people are demanding pay rises. Once people get pay rises, and we've said this before, they tend to go out and spend that money in the wider economy, so therefore demand doesn't necessarily go down. So this idea that you raise interest rates will cut demand straight away, there is a bit of a lag. However, what we want to achieve, or what we want to see happen, is that they don't raise interest rates in such a way that you create what's called a hard landing, i.e. a massive crash in the economy. And again, jumping back to Jerome Powell, the guy from the Federal Reserve in America, he suggested that a soft landing, avoiding a recession, is still very much possible. And what he said was, it's possible we can continue to have the cooling in the labour market, i.e. people getting laid off, but not huge amounts of job losses, without a big massive increase in unemployment, and wage increases that have been going up aren't going up at the same rate, and that's a good sign. So that's what they're looking for. So if we do avoid a huge global recession in 2023, then that is exactly what the markets will want. So looking closer to home now, you can see the graphic there regarding Sainsbury's announcing earlier this week that it's going to start cutting the price of its own brand bread and butter. This is a great sign, because supermarkets over the last 12, 14 months perhaps have saw that we've entered high inflationary times, and I believe have tried to profiteer as much as possible. And it's not just the supermarkets, it's obviously the companies who create the products. Heinz was a great example of a company that just wanted to whack its prices up because it had the opportunity to, and you haven't seen anything in the way like a price war to try and drive more custom their way. So Sainsbury's now starting to do this, hopefully is the start of other big supermarket chains, etc., starting to bring down their prices. And in the UK especially, the major part of inflation numbers that came out last month was because food price inflation was still really, really high. The British Retail Consortium said there is a 3 to 9 month lag before wholesale price cuts are reflected in shops. I think politicians and such like should do a lot more of this to make it happen sooner. But generally, wholesale food prices are falling globally. And that's a good thing. But UK food price inflation is at a 45-year high, currently at 19.2%, which I think is absolutely scandalous. So if they can, as I say, get this down in the coming months, then it's going to be good for the inflation numbers, and it's going to be good for the end consumer. Final parts of the presentation as usual, where we look at investment performance of the various indices around the world. As you can see, when we mention volatility, in the past, when I've described what a graph may look like, I might have said look like a heart rate monitor. That thing there looks like an awful roller coaster that I wouldn't go on in a million years. As you can see, up and down, then a huge down in March, and just as you got to the bottom, things rose quite quickly through April. But then unfortunately, as we got the end of April into May, we've seen some further falls. Thankfully, at the end of the graph, you'll notice that we are kind of on the way back up. May historically has been a good month for markets. Earnings season and such like, where big companies are announcing their earnings and profits for the year, is around about this time. So hopefully we see some good continued news stories come through there, and we'll see markets go up. FTSE 100 up 5.97%. MSCI World Index 4.15%, and surprisingly the S&P in the US is only up 3%. And when I say surprising, it's because some of those big technology companies, Amazon, Facebook, Google, Apple, etc., have done very well since the start of the year, but obviously the rest of the index are not doing as well as the bigger ones. But as I say, very volatile, but let's just keep an eye on it. When you look at that over 12 months, again, FTSE 100 is best performing index, dominated by the oil companies, the mining companies, the pharmaceutical companies, the banks. As I say, the big banks in the UK have been announcing record profits recently, as well as your BP and Shell and such like, with all the money that was made in oil in the last 12 months. But again, look at the graph, very, very volatile. Now stretch it out over 5 years, and the S&P 500 just dominates, up 76% over 5 years. So although we might focus on the short term, and it's human nature to do so, you look at a 5-year graph and you should always make those sorts of returns over the long run. FTSE 100 lags way behind over 5 years, again dominated by negative news stories with Brexit, COVID, etc. over that period of time. It'll be interesting to see how that market performs in the coming 12-18 months. UK election on the cards. I know the Conservatives were decimated in the council elections last week. One of the things we were reading in the press just a couple of days ago is they might consider getting rid of inheritance tax and such like. So to pull a rabbit out of the hat, they might start giving away some things like this. There will be a general election in the US at the end of 2024. Mr. Biden announced that he is going to run again, aged 80, which is absolutely incredible. And the Republicans obviously have Donald Trump as their still main candidate, which again, if you read everything that's going on in his world right now, that's also incredible. So the biggest country, the most important country in the world, just having these two people as potential presidents is quite scary, really. But we're not expecting this volatility to go away in the short term. Still a lot going on in Ukraine, inflation still here. Interest rates, where are they going? So we keep an eye on it, but look at the long-term charts there, and you will be rewarded for investing over the long term. So thanks again for listening to another Wealth of Advice market update. Any clients have any queries, questions, concerns, please don't hesitate to get in touch with your usual contact, Failing that, we'll be here with another update in a few weeks' time. Thank you.